In this last explanation, before we go to some worked examples on time to trade, we're going to explain equalisation payments. An equalisation payment is effectively money that is returned to you because when you bought the units, it either had interest or dividends built into the valuation of the units, and that those dividends, that interest, was already destined to be returned to some investors. However, when you bought your units, it was included in the value. Therefore, a couple of key points. Equalisation payments are therefore a method of returning capital to investors who bought units that contain these dividends or interest payments that they will never receive. Okay? The equalisation payments are made against what are called Group 2 units. A unit, if you buy a unit where some of the value of that unit is destined to be returned to other investors, then that is classified as a Group 2 unit. Okay? Equalisation payments then should be used to reduce the cost of the Group 2 units. Okay, so if you paid, shall we say, 100 pence and 10p of that contained interest or dividends that you're not going to receive benefit from, then when it comes to calculating gain, the value of the units will be reduced from 100 pence to 90 pence. Okay. And lastly, the equalisation payments are commonly reinvested but can be taken as cash. So if you get the money back, or if you get it back, it's treated as return of capital and there's no tax liabilities. If you reinvest the money from Group 2 units, then that's treated as a purchase on the date that you reinvested the money into purchasing new units in the fund. So if we just go to a worked example now. Again, it's the same example. So in this case, we're saying on the 1st of January, bought again 10,000 units at 300 pence. Now on the 1st of May, we're saying that we purchased another 5,000 units. But this time, they were classified as Group 2, as in they contained dividends or interest that was to be returned. And we paid, in this example, £10,000, okay, for those Group 2 units. On the 1st of August 2007, when you get your statement back from the broker, from your fund, there's a repayment or return of capital. In this case, £500 was returned against the Group 2 units. So as we said, the equalisation payment then is then used to reduce the cost of the Group 2 units. So reduced from 10,000 less the £500 received, and the cost from the perspective of calculating future gain, etc., is 9,500. Now, something that's very important, or a key difference between notional distributions and equalisation payments, is that a notional distribution is apportioned over all of the units that you have, whereas an equalisation payment is typically made against a specific transaction. So in this case, an equalisation payment was made against these 5,000 units and not the 10,000 units purchased in January 06. So you reduce the cost of a specific transaction. Now if you take a look at some worked capital gains taxation or calculations, I'll show you these calculations worked through in time to trade.